Most people are taught a very simple story about money. It's a story that feels logical, comforting, easy to accept. Governments issue money, banks keep it safe, and each country controls its own currency. This idea fits perfectly into everyday life. You earn money inside your country. You pay taxes to your government. You save your money in a local bank. Everything feels contained, organized, national. Because this story feels so familiar, most people never question it. And as long as life feels stable, there seems to be no reason to. But that changes the moment something goes wrong. When prices rise faster than wages. When housing becomes unaffordable. When your savings feel like they buy less every year. When headlines start talking about inflation, rate hikes, or currency pressure. At first, it feels personal. Then it feels confusing. And eventually, it feels out of your control. That's when the explanations begin. Inflation, political instability, global uncertainty, interest rates. These words sound technical, distant, abstract, and quietly, they all send the same message. This is complicated. This is normal. This is just how the world works. But here's where the story starts to crack. If money were truly controlled at the national level, if governments really held the reins, then financial problems should stay local. A policy decision in one country should not be able to reshape economies everywhere else. And yet, time after time, we see exactly that. One interest rate decision, one financial policy shift, one market shock. And suddenly, currencies move together, stock markets react in sync, capital flows reverse across continents. People feel the impact even if they've never heard the name of the institution involved. This is the moment when the old explanation stops working, because if money were simple, the world wouldn't behave like this. If money were purely national, global markets wouldn't move as one system. So the real question isn't whether money matters. The real question is deeper than that. In the next few minutes, we're going to map the forces that actually move global money. Not headlines, not politics, but the mechanics beneath it all: credit creation, liquidity, and the channels capital flows through. And once you see that map, inflation, bubbles, and currency swings stop feeling random. If money shapes the world this powerfully, who is actually shaping money itself? To understand who controls global money, we first need to understand what money is not. Because most confusion around money comes from assumptions we never question. The first assumption is that money is backed by something real. For most of history, it was gold, silver, something scarce and physical. Money couldn't grow faster than the metal behind it. That world is gone. Modern money is no longer tied to gold or any physical asset. It is fiat money. Its value does not come from what it can be exchanged for, but from trust, from the belief that others will accept it tomorrow. The second assumption is that money exists as cash, bills, coins, something you can hold in your hand. In reality, physical cash makes up only a tiny fraction of the global money supply. Most money exists digitally, as numbers, as entries on balance sheets, as promises recorded inside banking systems. This is why banks don't keep all deposits in cash. They don't need to. The system was never designed for everyone to withdraw everything at the same time. This is why bank runs are so dangerous. Not because people suddenly panic, but because they expose how the system actually works. Your bank balance isn't a pile of cash waiting for you. It's a promise, one that only holds as long as the system stays calm. The third assumption is that governments create most money. This is one of the most common misunderstandings. Central banks can create reserves. They can influence liquidity. They can stabilize markets during crises. But the money people actually use every day for homes, businesses, and consumption is mostly created by commercial banks. When banks issue loans, new money enters the system, not transferred, created. And finally, there is the assumption that money stays inside borders. It doesn't. Capital moves constantly between currencies, between markets, between countries. It flows toward higher returns, toward safety, toward stability. And when conditions change, those flows reverse fast. Each of these facts is widely known on its own. None of them are controversial, but together they create a problem. If money isn't backed by something physical, doesn't mostly exist as cash, isn't primarily created by governments, and doesn't stay within national borders, then money isn't a national object at all. It's something else. And until we understand what that something else is, the question of control remains unanswered. So let's talk about how money actually comes into existence. Block 3. How money is actually created. Once we remove those assumptions, a different picture of money begins to appear. Money today is not a thing. It's a process. Most people imagine banks as vaults, places that store money and lend it out. But that's not how modern banking works. When a commercial bank approves a loan, it does not take existing money from someone else and give it to the borrower. It creates new money. The moment a loan is issued, new money enters the system. A mortgage creates money. A business loan creates money. A credit line creates money. This is how most money comes into existence, not through printing presses, but through credit. The loan becomes an asset on the bank's balance sheet. The deposit becomes spendable money for the borrower. This process happens quietly, every day, across millions of transactions. And it's why money can expand rapidly during booms and contract painfully during crises. So where do central banks fit into this? Not where most people think. Central banks do not decide who gets loans. They do not fund daily spending. They do not directly inject money into your bank account. What they control are conditions, interest rates, access to liquidity, regulatory constraints, and most importantly, confidence. Lower interest rates make borrowing cheaper. Higher rates make it harder. Loose conditions encourage risk-taking. Tight conditions discourage it. In other words, central banks don't create money directly. They shape the environment in which money is created or destroyed. This indirect influence is powerful because banks respond to incentives, borrowers respond to costs, markets respond to signals. When confidence is high, credit expands. When confidence breaks, credit contracts. And because modern money is built on credit, these shifts ripple through the entire system. This is the moment where money stops looking static. It starts looking alive, expanding, contracting, flowing. And flows don't stay in one place. Once money is created, it moves toward opportunity, toward yield, toward safety, which brings us to the larger picture. Because when these credit-based flows cross borders, they don't just affect one country, they reshape the global financial system. And once you zoom out, something else becomes clear. Global money doesn't flow randomly. It moves through a small number of choke points, places where liquidity concentrates, decisions matter more, and the entire system responds. That's the map. Once money is created through credit, and once it begins to flow, structure starts to matter. Because not all financial systems are equal. Some countries have deep banking systems, large bond markets, highly liquid currencies. Others don't. This creates a hierarchy in global finance, not by design, but by function. At the center of the system are currencies and markets that global capital trusts. They are easy to trade, easy to store value in, easy to move in and out of. Around that center are countries whose financial systems depend on those core markets. When global conditions are stable, money flows outward, into emerging markets, into riskier assets, into growth opportunities. Credit expands, investment increases, asset prices rise. But when conditions change, those flows reverse. Higher interest rates, tighter liquidity, rising uncertainty. Suddenly, money pulls back. Not because something went wrong locally, but because the global environment shifted. Capital moves toward safety, toward liquidity, toward the center of the system. This is why financial stress often appears global. Currencies weaken together. Markets sell off at the same time. Countries far apart feel similar pressure. It's not coordination, it's structure. Global money moves through shared channels. Bond markets transmit stress. Banking systems pass liquidity across borders. Currency markets amplify shifts in confidence. No single institution controls this entire system. There is no central switch. But some institutions shape the terrain by influencing interest rates, by setting liquidity conditions, by acting as anchors during crises. And some currencies sit at key intersections of the map. This doesn't require villains. It doesn't require secret meetings. It only requires incentives and a system built around trust, liquidity, and scale. Once that system exists, money follows its logic. And once you see that logic, global financial events stop feeling random. They start feeling connected because they are. And this is where the map stops being abstract. Once you see this map, the world starts to feel different. Not simpler, but clearer. Things that once felt random begin to fall into place. Inflation stops feeling like a mystery. Asset booms stop feeling like accidents. Currency swings stop feeling sudden. They become signals. When money expands easily, prices rise. Not just consumer prices, but asset prices. Housing, stocks, land, anything that absorbs excess liquidity. And when conditions tighten, those same assets struggle. Liquidity pulls back, credit slows, risk disappears. This is why entire cycles repeat. Booms don't happen because people suddenly become optimistic. Busts don't happen because people suddenly panic. They happen because money flows change. Understanding this doesn't give you control over the system, but it gives you something just as important: orientation. You stop reacting emotionally to headlines. You stop treating every event as isolated. Instead, you begin asking different questions. Is money expanding or contracting? Are conditions becoming looser or tighter? Is capital moving outward or pulling back? These questions matter more than daily news because they tell you where you are in the cycle. This perspective also changes how you see personal risk. When money is abundant, risk feels invisible. When money tightens, risk suddenly feels everywhere. But the risk didn't appear overnight. It was always there. The system simply stopped hiding it. This is why understanding the structure matters, not to predict exact outcomes, not to outsmart the system, but to avoid being surprised by it. You may not control global money. You may not influence interest rates or redirect capital flows. But once you understand how money is shaped and how it moves, you stop mistaking symptoms for causes. You stop blaming isolated events for systemic outcomes. And most importantly, you stop feeling lost. Because when you see the map, you know where you stand. You may still be inside the system, but you are no longer blind to it.